tried to do some research, but I kind of kept coming to the same shit, so I don't know how.
All right. Hello, everyone. It is June 3rd, 2016. We are the JVN Research we are the JVN Research Group. That's our unofficial name for now, because we haven't come up with a better one yet. But I'm Matt. I'm joined by Frank and Eric. We are missing Suraj today. We don't know where he is, probably watching basketball games. But today we are going to talk about analyzing companies' quarterly reports and the importance of doing so for the investor. So at this point, I'm going to let Eric start off by talking a little bit about quarterly reports, since he's probably the most experienced in analyzing them. So take it away, Eric.
Hello, everybody. Matt, Frank, it's good to be here, of course. But yeah, earnings report. Let me see. Man, the nice thing about earnings reports is that, you know, if there's any kind of catalyst out there that could drive the market up or down, it's either a very good or terrible earnings report. That being said, I think pretty much the holy grail of trading stock is to be able to know when a good earnings report comes out or when a bad earnings report comes out, or know how to quickly interpret whether or not a good earnings report is good or a bad earnings report is bad. Because the faster you interpret that, is the faster you can make a very good decision on whether or not to buy stocks or to short stocks. So that being said, what makes an earnings report good or bad? There's a lot of information in earnings reports, and that's the thing. It's like there's a lot of information about how the company did that particular quarter. Different things about not types of products, but the amount of products they sold. And I wish I had one up right now to talk about it. But the thing is, all that stuff is really not that important. The most important thing in an earnings report is what's called the EPS, the earnings per share or something like that. And you guys have to forgive me for if that's not right, but I believe it is earnings per share. Now, the earnings per share is very important because that number is what really makes investors either buy or sell the stock very quickly without having to read through a very, very boring document called an earnings report. Now, the EPS, how is that important? Well, the EPS is only important based on its relative position. So a high EPS is not necessarily a good or bad thing if the last quarter was higher than it. If the last quarter had a higher EPS, that's not necessarily a bad thing based on where the company was a year ago. So the EPS is always relative. So if the EPS of a company went down this particular quarter, but the following year the EPS pretty much doubled, the company's still doing pretty good. And investors might not, go crazy and buy the stock, but they definitely won't start dumping the shares.
I put a link in the chat to an ExxonMobil quarterly report if you want to click on that to use as your example.
Okay, let me take a look at that.
Yeah. So the EPS, the earnings per share, is one piece of information that we do show on our web application, jvion.com, JEAVION.com. It is on the research page. When you enter a company, the EPS does show up. That's one of the key pieces of information that we do show. Perhaps, based on what you just said, it would be wise for us to show previous EPS numbers.
Absolutely.
That's probably something we should put in there to help investors figure out.
Absolutely. Yeah, Matt, and I'm so glad that you mentioned that it might not be a bad idea to go ahead and put that in there, because I really do believe that will be a great addition to add to JVion, because there's actually a lot of websites who make business actually showing the company's historic EPS.
Cool.
I think that definitely be something that investors would be able to appreciate. But like, if I'm looking at um, this particular earnings report, like, there's a lot of stuff, like, you know, millions of dollars they made in one quarter. Like, this stuff is important. Don't get me wrong. Like, all this stuff is very important, but all this stuff kind of helps come up with the EPS. You know, and there's also something else I want to mention too. But yeah, Matt, this is pretty much great. But let me see how many pages this is. This is like a 20-page report.
It's a very colorful report too. I like it. It's pretty.
Yeah, it's very pretty, very colorful. But this report is actually pretty exciting compared to some of the reports I saw, which pretty much were just like a PDF that looks like a spreadsheet.
Mm.
No graphics, just text and a total, pretty much. Now, I do see that there's the earnings 1.8, cash flow. All that stuff is very important, but the most important thing.
What page are you on? You're on page number 3?
I'm on page 19.
Oh, 19.
Yeah. But there's something else though too I wanted to mention, Matt, before I let somebody else go.
Sure.
Is that there's something called an earnings whisper. I don't know if you ever heard of that before.
No, I haven't heard of an earnings whisper.
Yes. The earnings whisper is very kind of complex, and this is why it's complex. Earnings whisper is almost like, what are people kind of feeling the earnings report should be in order for this to be a good thing. Now, let me give you an example of that. Apple, for example. I was in Apple, big surprise, right?
Mm-hmm.
I was in Apple one particular quarter, and people were talking about, that Apple wasn't going to make the earnings whisper, which is an EPS that like, there's two types of EPSs. There's the EPS that a lot of analysts in Wall Street kind of give a company to say it's growing healthily. It's like, okay, if it reaches this number, it's relatively healthy. Sometimes the analysts, based on data that comes out during the quarter, could give a company a low earnings report, which naturally the investors would actually start selling their stock as that time comes, because they're expecting the earnings report to be low. So the analysts on Wall Street kind of come up with EPS that's kind of like the official EPS that the company should be making based on information that came out during the quarter. Like, one example of that is, Apple having a company in China, and that company in China start laying off a bunch of people. Right there, that's telling people that Apple's not selling a lot of iPhones, because this company that helps make the iPhones for Apple in China are laying a lot of people off. Bad sign. So right there, that affects the earnings report based on that information. Now, the earnings whisper is different. The earnings whisper is also based on some sort of technical stuff. For me, it's completely gray. But the whole idea is, it's like, what are people expecting the earnings report to be for it to be huge for the company?
So is an earnings whisper something that you can expect to hear before the official earnings statement is released by a company?
The earnings whisper is more like, what are the investors talking about that they feel is a good earnings, a good EPS? So let's say, we have a company, right, and Wall Street is saying that our EPS should be 1.5. Okay?
Mm-hmm.
Now, the earnings whisper is 2.0. If we reach our 1.5, we might actually, depending on like what that is relative to the previous quarter, we might, people might start dumping our stock. But if we reach the magic number 2.0, we might go up 10 or 15%.
Oh, wow. Okay. That's interesting.
So that's pretty much what the earnings whisper is. There's two types of earnings report, like earnings that are kind of like analyzed and predicted. There's one from Wall Street analysts, which is kind of like, you can go to NASDAQ and see what that is for any given company. and then there's the earnings whisper, which is like, what are people's sentiments about this particular stock for it to be a very good thing if it reaches that.
Okay.
Yeah.
Interesting. All right, that's definitely some good information there. So I'm going to do a screen share so that we can look at this earnings report by ExxonMobil.
Mm-hmm.
Share, and just going to share my entire screen. And there we go. Can you guys see it?
I can't see it yet.
You can see it yet?
No, I'm still looking at you.
Go ahead and click on share yet. Share. There we go. Okay.
Yes.
There we go.
Okay, so there it is. I'm going to minimize the Hangout screen behind that so you can see. And there we go. First quarter 2016 earnings call by Jeff Woodbury, the Vice President, Investor Relations and Secretary, released on April 29th, 2016. ExxonMobil. Yeah, this is a pretty, very pretty cover right there. A nice little. It looks like an oil rig, I think. Possibly an oil rig. I don't know.
I think it's an oil rig. I mean, no, an oil refinery maybe.
Oil refinery. Yeah, lights all over the place. Yeah, very good looking report. It's a nice PDF format, and yeah, look at that. So it's such a good thing. All right, so the first thing we got here is a cautionary statement that is found on page 2. Outlooks, expectations, forecasts, estimates, targets, business plan, and other statements of future events or conditions in this presentation or the subsequent discussion periods are forward-looking statements. So this is pretty much saying this is what they expect, right?
Mm-hmm.
Yeah, okay. And they got some frequently used terms here. The term project is used in the presentation can refer to a variety of different activities and does not necessarily have the same meanings as in any government payment transparency reports. I'm not sure what they mean by that, but I'll just take that at face value. So third page, they have headlines. First quarter earnings of $1.8 billion. So they earned $1.8 billion in their first quarter. That's a lot of money.
That's yeah. I mean, it's very good, but again, you know, compared to what it was last quarter, it might not be a good thing.
That's right. It says here generated $5 billion in cash flow from operations and asset sales. Strong chemical results reflect gas and liquids cracking advantages. Not sure what that means. Strong chemical results reflect gas and liquids cracking advantages. Are they talking about fracking? Do you think that's what it means?
That's a very good question.
I have no idea. Well, there's another thing I don't know that they're talking about. Steady progressive on investment plans. CapEx decreased 33% from quarter 1, 2015. So I think what that means is that their capital expenditures has decreased by 1/3 from a year ago. So I think that's a good thing. They're not spending as much money on equipment as they were a year ago.
Mm-hmm.
Possibly, maybe. I don't know. All right. So
ask that again one more time.
Either way, so far it's looking positive.
yeah, it says here steady progress on investment plans. CapEx decreased 33% from the first quarter in 2015. So I think what that means is that they've reduced their expense on capital expenditures.
Gotcha.
I think. I'm just guessing.
Yeah.
Okay, on page 4, they have business environment, and it says global economic weakness persisted during the first quarter. So the U.S. growth slowed further.
Yeah.
That's interesting. China continued to decelerate. Modest improvements in Japan and Europe. Crude oil and natural gas prices decreased. Now here's an interesting thing, because when the price of crude oil and natural gas go down, that's good for the consumer. That's good for people like us who have to fill our cars. But that's probably very bad for a company like ExxonMobil.
Yes, it is.
So that's like a double-edged sword right there. I mean, I bought a hybrid back in 2013 when gas was close to $4 a gallon. But of course, I lived in Western New York at the time, and gas is a little bit more expensive over there than it is in the rest of the country. So 2013 gas was like $4 a gallon. Now it's I think it's like $2.20 per gallon. Now that we're in the summer of 2016. And I think that's wonderful. I mean, I could fill my tank for around $20 and drive for a week and a half on that. But I don't think ExxonMobil likes that too much because no, I'm not spending as much money on their gas. All right, so the global refining margins weakened on lower distillate demand, so the demand decreased. And you know, let's to think about that for a second. If you think back 10 years ago, everybody seemed to be driving SUVs.
Yeah.
If you go back 10 years, 2005, 2006, people were in sport utility vehicles, trucks. Hummers were really popular. You know, you can get the Hummer V2, V3, those big ass trucks. And at the time, I drove a little station wagon, and I felt like such a little tiny bug on the street because everybody else had such a bigger vehicle. But now you look around, cars are so much smaller.
Yeah, like Europe, like in Europe.
Yeah, I mean, we got those Mini Coopers that are out there now. So many more people are driving hybrids, and I'm one of them.
Yeah.
You know, less people are driving trucks, less people are driving vans.
But you know, Matt, I sent you like 2 links.
Mhm.
I like you when you get a chance, maybe during a broadcast, to look at the last link I sent you about the EPS.
Okay, absolutely. Once I'm not doing the screen share anymore because we'll get that continual the forever mirror effect going on.
Okay.
So let's see. Now, in the last point on here is chemical commodity and specialty margin strengthened. Chemical commodity and specialty margin strengthened. So I think what that means is that niche markets got better. I could be wrong. What do you think?
You know,
wording,
go ahead.
I was going to say the wording isn't exactly clear. It's hard to tell.
Yeah.
You know, back to what I was saying before, with this, timing is everything. You know, you can look at that report and you think that it might be a bad report that you're reading, and the only way you know whether it's good or not is because everybody's buying up all the shares before you get a chance to do anything, or they're dumping the shares before you get to do anything.
Yeah.
The most important thing is to figure out what the EPS is as soon as possible. All this other stuff is all well and good, but this stuff right here is mostly for the company to give to its shareholders. When people are asking what happened, or you know, when you have those big company meetings, and you know, I don't know if you guys ever been to one, but I used to go to them a lot for Synchronous, and being at those company meetings, you know, they kind of tell you about how the company's doing or why the company's doing bad, and they have stuff like this to tell you exactly what the company is doing as well as you know, they would have hoped it would do. But like this stuff, like when you're trying to beat the market before the market beats you up, you really want to know what the EPS is and move on.
Yeah, definitely.
Now, if you when you get a chance, I want you to take a look at that link and share it with everybody about EPS to really discuss that, because to me that's the most important thing about one of these earnings reports.
You know what I could do is I could put it in the link of the video on YouTube, so that way the people who are listening or watching can click on that and follow along.
Sure.
At some point at their own leisure. So, okay, on page 5, we've got the earnings at 1.8. The earnings per share are 0.43.
That's the EPS.
Yep, EPS, earnings per share, 0.43. Now what I'm going to do is I'm going to open up another tab here, and I'm going to open up our webpage, Javion, and see if that actually jives with that. Now, Javion takes a while to load at the moment because it's a Ruby on Rails application, and if it hasn't been accessed in a while, it falls asleep and then it wakes up. So I'll just give that a minute. All right, so earnings per share is 0.43. That doesn't seem very high. That's less than 1, but that's okay. Maybe it's not bad. Shareholder distributions is 3.1. CapEx 5.1. Now this must be in billions, I think. Does that sound right? In billions?
If you look at the bottom, it says billions of dollars unless specified otherwise.
There we go.
Mm-hmm.
So that's actually a hell of a lot of money.
Yes, it is.
Cash flow operations.
Eric, I have a
anything else? Go ahead.
I was going to say, Eric, quick question. Do all quarterly reports come out as simple as this one? Where it's
No,
actually saying each of those figures?
no. It depends on the company and everything. Like most of the ones I've seen, it's pretty much like a spreadsheet that you see in Excel, but but on a PDF, and it's just pretty much like a balance sheet. That's the best way to explain what it looks like. Very boring, huge numbers thrown around all over the place, and it comes up with a total. And you yourself as an investor could take that total and calculate the EPS yourself. Some of them were nice enough to put the EPS in there for you, but some just give you the pretty much like the numbers that you need to calculate your own EPS.
Okay.
Yeah. Okay. So on our web application JBeon, I typed in XOM for ExxonMobil, and I don't have the EPS on the main page, on the main tab under calculated data. I should definitely put it there, but it should be under raw data, under I think under dividends and financials. So I'm using the Yahoo. I'm using Yahoo to get this information. I'm not entirely thrilled with the information that I get back from Yahoo, to be honest with you. I think what I'm going to want to do is I'm going to want to allow people to, after they sign up for an account on the web application, to be able to enter their own preferred trading broker, whether it be TradeKing or Scottrade, and then we can hit that API using their own preferred broker to get this information. Or we could default to Yahoo if they don't have this. I don't think I have EPS in the application. I think I should definitely put that in.
I think that's really important.
I have the EPS estimate, the earnings share, whatever that may be, and the EPS estimate next year. And then here's the EPS estimate next quarter of 0.79.
Mm-hmm.
So, interesting. I don't have a number on here that jives with the report from ExxonMobil.
You know what? I think it's very interesting. Oh, wait, can you tell me what the ticker is for ExxonMobil?
XOM.
XON?
XOM, as in Michael.
Oh, okay. I thought it was XON. Okay, let me just take a look at something. Because you asked a very good question. Is that EPS a good thing? I'm gonna tell you right now whether or not it is. And based on what I tell you, I want to take a look at the chart. And we can share your screen and see when that earnings report came out. Let's see if I can predict whether or not the stock market fell. And all you need to do is put that in Google, and we'll talk about that. But let me just go ahead and try this out real quick. So I'm taking a look at the earnings. Okay, yes. So on April 29th, the earnings per share was 43. Now, I'm going to tell you right now, looking at this earnings report, and based on its relative position, so to say, that the stock fell. I'm saying that the stock fell on April 29th. So, and Matt, the whole point of this is to show you and show the audience that when I say the EPS, based on its relative position, is going to determine whether or not the stock market actually, dropped.
Well, the stock on April 29th closed at 88.40.
Okay.
And the previous day
It should have dropped.
was 88.03, so it actually went up 37 cents.
Oh, and this is April. Let me see. April, yeah, look at that.
So
Wow.
30 cents, and the next day it went up again, and then it dropped.
Interesting.
So it hit a peak on May 2nd, and then it dropped May 3rd by quite a bit, actually.
Yeah, I would expect the drop to be more immediate than it actually was.
Maybe they didn't release it to the public until May 2nd or May 3rd.
Okay, because like the reason why I say that is because I'm taking a look at the EPS, and the previous quarter was 0.67, and the quarter before that was $1.01.
Mm.
So it's going down. What that's telling me is that the company itself, Exxon, is actually declining as we speak. So can you go back to that and take a look at this, what the stock was a year ago? Because we should see a decline if we take a look at it from like a year.
Yeah, it looks like it.
Let me see. Yes, that's what I expect to see. Because like you're looking at just look at the EPS numbers themselves, you're seeing that this company is not making as much money as it was a year ago,
Right.
and you're seeing it like decline, like actual revenue, 111 billion. Then the next quarter, 107 billion. Then the next quarter, 87 billion. Then the next quarter, 67 billion. 67 million. I'm sorry. So one quarter from 2015 to April 2015, it went from making $87 billion to
Yep.
$67 million.
Yeah, and I displayed that on our financial data. There's annual period 1, period 2, period 3.
Yeah.
You can see, starting from in 2013, the number was between 2013 and 2014 was about the same, went down a little bit, but it significantly decreased at the end of December 31st of 2015. So yeah, this company was definitely hurt by
Yeah.
declining oil prices.
And for the record, when it went from 87 billion to 67 million, the EPS when it was 87 billion was 156.
Yeah.
When it dropped to 67 million, the EPS was $1.17. So that
Wow.
EPS dropped about 40 cents.
Wow. Yeah.
Yeah.
So definitely a lot of good information that we're putting on our application here. And I know this is completely shameless self-promotion, but I think we wrote a good application. I mean, it could really help people in their research and deciding when and how to invest. And also, people, keep in mind, people listening, you can still make money in the stock market when things go down. And we're not going to tell you how to do that today. That's a topic for another time. But just because a company is losing money and their stock is declining is not necessarily a bad thing for you, the investor. But we'll get to that someday. So, okay, back to the quarterly report. Debt. This company has quite a bit of debt. Oh man, I mean, look at this. The cash is 4.8 billion. Their debt is 43.1 billion. That's a lot of debt. I mean, $43 billion in debt. Wow. All right, so moving on.
I hate to be them.
What's that?
I said I hate to be them.
Oh, yeah. All right, so moving on. On slide number 6, the beginning cash balance increased by 1.1 billion in the first quarter, so they were able to increase their cash balance, which that's a good thing. Just like every company, they have depreciation in their equipment, and they put that at 4.8 billion. So that's quite a bit of depreciation in their equipment. They must have a lot of moving parts over there, I'm guessing. All right, so working capital decreased by 1.8 billion. Proceeds associated with asset sales is 0.2 billion. Shareholder distributions decreased by 3.1 billion. PP&E adds investment yeah, there we go. I can talk today. PP&E adds investments and advances was a negative balance of 4.5 billion, and the debt other financing was 3.7 billion. So their ending cash was 4.8 billion. Now, I don't know how they come up with these numbers, and I don't know what the PP&E is. You know what that is?
I don't.
Yep. So I don't know how to read this page.
No, I hate to say it. To me, that's not going to help me get to the EPS.
I'm going to do a search for PP&E. What's PP&E? Property, plant, and equipment.
Okay, that's important.
All right. Okay, so the next page. Total earnings. Quarter 1, 2016 versus quarter 1, 2015. Let's see. Yeah, significant decrease. Decrease here. Well, starting here, over here at 4940 millions of dollars. So that's like 4.9 billion down to 1.8 billion. So remember, when we saw the first page, we saw that they made 1.8 billion, and we said, wow, that's a lot of money. But when you look at it retrospectively to the prior year, that's a huge decrease in what they used to be making.
And actually, I said that. I said it depends. It's all relative.
Absolutely.
Yeah.
So you can't take it at face value. I mean, so when the quarterly reports come out and someone says, "Oh man, they made 1.8 billion dollars," you can't just go out and buy the stock right away because, well, is that more or less than what they did a year ago? In this case, it's significantly less. Wow, pull your stuff together, ExxonMobil. All right. So earnings decreased. And it said here that chemical results partly offset the upstream and downstream earnings. So I guess what that says to me is that they're figuring out a way to not lose as much money, which is probably a good thing for them. Okay, and moving on to the next one. Earnings decreased by 2.9 billion due to sharply lower realization. So they spell it out in black and white, well, figuratively in black and white on this page, that their earnings decreased, over the past year. So I wonder if this is a good stock to buy. I mean, is this stock on sale or is it overpriced? So looking back at our web application here, we've got a PEG ratio of 1.23, PE ratio of 28.46, and using Warren Buffett's formula to determine a company's value in 1 year, it says here that the value is $93.15, which their current stock price is $88.44. So if everything is correct, and I did my math correctly, the stock is underpriced. And it would actually be a good value for a long-term investor. So if you bought a lot of shares at $88.44, it'll be worth, by our calculations, $93.15 in a year. For sure.
Can you scroll down? And
yep.
I just want to see what Javion says. So yep. Javion is expecting this to continue to fall. My concern is looking at a historic trend of the earnings reports. Is it over? And and I'm not sure at this point I will go ahead and invest in it because I don't really know, quote unquote, if it's over.
True. So this chart right here, the short-term movement projection, is a formula that we came up with ourselves that tries to determine what the stock is going to do the next day. So today is June 3rd, and it closed at $88.37. And if the trend continues, on Monday it will close at $88.10 a share. So we're expecting this stock to decrease by next week. And we use this, the formula we use, we're not going to tell anybody what the formula is because it's proprietary, this belongs to us. But we base it on weighted moving averages. And this is what we come up with. So we think it's going to decrease on Monday. Pretty neat, huh?
That's very neat.
All right.
It's very neat.
So back to the quarterly report. I'm actually getting pretty bored. Reading all this stuff, and I think
okay. Let's go ahead and switch gears then, and pull up one of the links that I sent you.
Sure.
Yeah.
Okay. Let's see.
Like the last one I sent.
The last one, Investopedia. There we go. I like Investopedia. Net income minus dividends on preferred stock divided by average outstanding shares. That's earnings per share, EPS.
Yeah, can you go ahead and share your screen like you did before?
Yes, sir.
Yeah. Everybody's kind of soak that in real quick.
So since we're a bunch of programmers, we're nerds. We love math. I mean, nothing makes us happier than having a formula to work with. Here it is.
Yeah, there it is. Now, Matt, like if you can you just scroll down to where it says, oh, I lost your screen. Here, give me 1 second. Let me pull your screen back up.
Sure.
Okay. Just give me one moment. Okay, right there. Breaking down earnings per share. Can you just take it from the top and read that part?
Sure thing. Earnings per share is generally considered to be the single most important variable in determining a share's price. It is also a major component used to calculate the price-to-earnings valuation ratio. For example, assume that a company has a net income of $25 million. If the company pays out $1 million in preferred dividends and has 10 million shares for half of the year and 15 million shares for the other half, the EPS would be $1.92. That's 24 divided by 12.5. First, the 1 million is deducted from the net income to get 24 million, and the weighted average is taken to find the number of shares outstanding.
Yeah.
And there's a little bit of a formula there.
Yeah. An important aspect of EPS that often is ignored is the capital that is required to generate the earnings, net income, in the calculation. Two companies could generate the same EPS number, but one could do so with less equity. That company would be far more efficient at using its capital to generate income. All the things being equal, would be a better company. Investors also need to be aware of the earnings manipulation that will affect the quality of the earnings number. It is important not to rely on one financial measure, but to use it as a conjunction with statement analysts and other measures. Okay, here's telling me, and here I'm actually being schooled on this point, is that the EPS is very important, but also use other statement measures that come out in the earnings report. Like for me, when I'm trying to figure out whether or not this is a good earnings or not, it's like I would like to try to calculate that EPS as quickly as I can, and let the other stuff go, because as I'm trying to absorb the other information, a stock's price is changing on me, because we all know it's all about time.
Yep.
And within an hour you can lose a very good deal, so to say.
Oh yeah, absolutely. So what this says to me is that companies will cook their books, and there's really no set in stone way to actually get the EPS. I mean, it seems like the number could be a little bit different. To achieve the EPS could be a little bit different depending on how the company calculates it.
Yeah.
So I think here's another formula that we need to look into, that we need to make for our own application. So
I agree.
Oh yeah, absolutely.
Now, could you also take a look at the earnings whisper that I sent you?
Sure.
To kind of so we can kind of look that over as well.
All right. I like the little stock image that they have up there. That lady, she appears on so many business websites. All right. Whisper number first came out in the early 1990s as a reference to earnings expectations passed along to large investors and institutional traders. Is that word? The word's kind of cut off a little bit. Traders, yep. Okay. During a period of exceptionally high earnings growth, the combination of naturally conservative analysts, especially on the sell side, and the expanded research departments by institutions primarily on the buy side, resulted in whispered expectations that were consistently more accurate than consensus earning estimates.
Now the consensus earning estimates are pretty much like the analysts on Wall Street.
Yeah.
Coming up with their expectations.
Yeah. I mean, they do this kind of stuff all day long. So
that's the consensus that's referring to the analysts on Wall Street.
So we're nerds without a doubt, but so are the people on Wall Street. And while we may understand code, the guys on Wall Street understand financials much better than us.
Much better, like accountants.
Oh yeah. So that's all they do day in and day out. And I'm sure that during the day, I mean, let's see, the opening bell is at 9:30, the closing bell is at 4:10. So they're trading constantly during the day, but during their off hours, I wouldn't be the least bit surprised if they don't stop working and they continue to crunch numbers to figure out what their next moves are going to be for the next day.
And actually, Matt, the closing bell's at 4.
4? Oh, is it 4? Oh.
Yeah, it's 4. Yeah.
Oh, I thought it went a couple minutes past 4, but.
Oh yeah, it's.
Anyway, So yeah, and I mean, when you think about the people on Wall Street, people think, oh, those bankers, they don't work. They work 9:30 to 4, and they make so much money, and they it's not earned. Well, I think it is earned. I think they do their homework, and I think they work very hard, and they, definitely earn. I mean, to be a good trader on Wall Street, I mean, you're talking about making millions of dollars in
That's
profit,
right.
and it's not an easy thing to do. I mean, so many people who have a natural talent for investing get discouraged if they have like a net loss their first couple of years of doing it.
Yeah.
And you can't let that discourage you. You have to keep doing it. You have to figure out what works for you. You have to figure out mathematics stuff. Hey, Frank, are you outside?
Yeah, I am.
No, okay. That's what I thought.
And also, Matt, can you continue reading from the consequently?
Consequently, by 1997, whisper numbers had replaced consensus estimates as the market's true expectations for earnings, and Michael Moe at Montgomery Securities said at the time, the whisper becomes, in effect, more important than the published number. The whisper is increasingly becoming the true expectation. That's fascinating. That is fascinating. I wish I knew some Wall Street bankers, Wall Street investors. I really do. I would love to have a Wall Street investor on the show just so I could pick his or her brain about stuff like this. It's like, tell me about the EPS whisper. How do you come up with that? I mean, is it a slightly different formula for each company? Is it a slightly different formula for each sector or a specialty? I mean, is it different for tech companies, different for financial institutions?
But the big thing about this whisper is if a company reaches the EPS whisper, then their stock is gonna explode.
Oh yeah.
If they hit the EPS whisper, that's a bad whisper, then this stock is gonna tank like very aggressively. But can you continue to read though? There are some studies because this is some interesting stuff, as you pointed out.
Yeah. It's about time for us to end, but I will continue reading before we do. There are some studies, such as the one published by professors at MIT, Northwestern, and Duke, that imply analysts publish their more conservative estimates to protect their jobs and verbally pass along or cite the more aggressive whisper numbers so they cannot be tied to them if they turn out to be wrong. Yeah, it's very dangerous to be wrong on Wall Street. Yeah,
especially in that field.
Oh, yeah. This applies to negative expectations as well, and other studies indicate analysts are more timid with their negative expectations for fear of alienating management. That's a very good point, because if you predict a boom and a boom doesn't happen, it's no big deal. But if you predict a collapse and a collapse doesn't happen, you lose your job. Yeah.
Isn't that great?
So therefore, contrary to many beliefs, conservative estimates do not always mean they are low for an easy hurdle. And in fact, research published by professors at Michigan, Indiana, and Purdue found whisper forecasts are, on average, more accurate than first call forecasts, and that their superior accuracy does not depend on whether they are greater or less than the first call counterparts. So that's fascinating. I mean, I didn't know anything about earnings whispers before today. I mean, I definitely learned something new today. So I need to figure out a way to get these earning whispers. Yeah.
I mean, you're talking about some big stuff, Matt. I'm telling you.
Oh yeah.
To pull that off.
Absolutely. But you know what? I think we can. We're relatively smart people. I think an earnings whisper is something that we should be able to come up with. I mean, there's several. Hey, Siraj is here. Siraj, when did you join?
I joined a long time ago. It's been almost half an hour.
Holy crap! I didn't even know you were here.
I don't believe it.
No, the thing is, you guys might have been messaging, but Cricket Wireless, the carrier that I have for a phone, it's been down for all over the country.
Oh.
Wow.
So I was not getting anything. So I checked my email. So there was the invitation and all. So I just joined you guys. But I'm outside.
Okay. Yeah, we were just about to wrap it up here because we like to keep this relatively short, so that way people don't lose interest and turn us off. I don't want to listen to 2 hours of financial talk. Well, no one else does either. So.
Well, I think it's very interesting. I think when we were going over the ExxonMobil earnings report, like all that fluff could be really boring because to me that fluff is more important when they have those internal meetings and they want to do a prep rally and they want to tell people, okay, things sucked because the crude oil price is low. You know, that's why your bonuses is so big this year. But when it comes to like the average investor that wants to know, is the EPS bad or not, and why is it bad? You just want the information as quickly as possible, then make a quick split decision right there, and move on to the next year.
Exactly. Yes.
Next up.
So the takeaway from this today is the EPS. You have to compare it to the EPS from a year ago and also the previous quarter.
Yes.
So are they doing better? Are they getting better? And the EPS whisper, which is something that Wall Street puts out, is extremely important and is detrimental to the company's success or failure for the short term.
And there's two earnings. There's two, like, I don't want to say two whispers. There's two EPS predictions. There's the one that there's the consensus, which Wall Street puts out. They put out the consensus earnings report. I mean EPS that they're predicting. And then there's a whisper, the less conservative EPS that if the company reaches it, then they're doing a fantastic job. In their business.
Great.
So there's a consensus, and then there's the actual whisper.
Awesome, man. That's great stuff. I love doing this. I'm learning so much. So we hope that the people who are listening or watching us, we hope you're learning stuff too. Subscribe to our channel. We know it's new, but we're going to keep bringing you good stuff as much as we can. Subscribe, leave a comment, visit our website, jvion.com, join the forums there. Use our tools. They're free. We don't charge anything for this stuff. We want people to be successful. So, I'm going to say good night, everyone, and until next time.
Bye-bye.
All right, and make sure compare earning per share a year ago.
That's right.
All right, that's the motto. Okay.
Have a good night.
You guys do the same.